Hello, investors and future investors. Welcome back to the channel. For today's video, I'm going to show you one of the simplest option strategies that can be used if you're trading with a small account. Now, if you're new to options or you want to use options in order to generate some consistent income to supplement your 9 to 5, then you just so happen to stumble onto the right video. I'm going to try to make this as simple as I possibly can, so go ahead and follow along. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. For today's video, I'm going to go through the simplest option strategy that's out there. And I'm going to show you how you could change the option strategy by making a slight tweak if you want to change it to a defined risk option strategy. Not only can you use this on a small account, you could also use this to graduate once your portfolio has grown, and you could implement this strategy over and over again and watch your portfolio grow. So without further ado, let's go ahead and get down and dirty with options. So for today's video, we're going to be using none other than SoFi Technologies. So you know how we do it. Let's go ahead and get the option chain open. And for that, we're going to go to Trade SoFi Options down to the bottom. Now that we have our option chain open, we're going to go ahead and we're going to start off this strategy. Now make sure to please follow along. And like I said, this strategy is perfect if you're trading with a small account, and it can be graduated if you're trading with a bigger account. So now we're going to go ahead to sell, and we're going to go ahead to put. Then we're going to go ahead and choose our strike date. So we're going to go ahead and open up the dates, and we're going to use the January 24th, which gives us 15 days out. The reason I'm going with the January 4th is because this is a very small option contract. This stock sells for $14.40 per share. So the further out you go, the better your premiums are going to be. So let's go with the January 2024th. Now I'm going to go ahead and select my strike price. As you can see here, this is your strike prices. The strike price is going to be these down here, and then your share price is going to be right here highlighted in green. So what you want to choose your strike price below this price right here. Let's go ahead and scroll down just a bit more. So I'm going to be going with the 1350 strike price. With the 1350 strike price, my chance of profitability right here is going to be 77%. Your chance of profitability tells you the likelihood of this trade going in your favor, and that happens to be around 77%. Now, this is an option selling strategy. So in real life, whenever you're selling something, you're going to have to receive some kind of compensation. The compensation you're going to be receiving is going to be 0.26 or $26. When trading option, each option contract is multiplied by 100 shares. So this is actually going to be, your portfolio is going to receive $26. Let's go ahead and we're going to click into it. So this is just the first part of this strategy. Stick with me. I'm going to show you how to make a slight tweak in order for you to continue doing this consistently to grow your portfolio. So this option strategy is the cash secured put. In order for you to do the cash secured put, you will need to leave what's known as a collateral. So the collateral you're going to have to leave is going to be $13.50. Once again, we need to multiply that by 100 shares. So that's going to give us $1,350. Now, if you're trading with a small account, $1,350 is going to work for you. Let's go ahead. We're going to hit continue and review. Now, if you're trading with an account, let's say $2,000, and you put $1,350 in one stock, that's pretty much it. You can't do any more trades. So I'm going to show you a way around that in just a second. Now, once you leave the $1,350 as collateral, you're going to be receiving this $26 here as premium. That premium is yours to keep no matter how the trade goes. What you're going to do now, you're going to divide your premium you receive, which is $27, by the $1,350, and that should give you around 2%. Now, 2% is not bad for this particular option strategy. So let's go ahead now and we're going to get out of this. So with a small portfolio, to do this strategy, you're going to need $1,350. Anyone with a small portfolio could definitely afford to do this. Now, here's what we're going to do. We're going to take this option strategy a bit further. Now, like I said, this option strategy is one of the simplest. You simply go to sell, you go to put, you choose your strike date, and then you go ahead and choose your strike price below the current share price. You receive your money, your premium. Story end, you wait until the contract expire, you rinse, repeat. Now, let's make a slight tweak to show you how to make this stock even more affordable. So now we're going to go ahead and change our date. Let's go to buy, and we're going to go to put. We're going to stick with the exact same strike date. So like I tell you, very simple. All we're going to do is that we're just going to switch up our cash secured put into a new strategy. And to do that, the only tweak you're going to make is go from sell to buy. Now, once again, we're going to go ahead and choose our strike price below our previous sell call and below our share price. And we're going to go to the one right below it, which is going to be $13. Now, because we're going to be doing a buy strategy, in this instance, we're going to have to pay some kind of compensation. That payment is going to be 0.17 or $17. Now, bear with me. Because of the slight tweak that we just made, we changed this option strategy entirely. This new option strategy is now the put credit spread. The put credit spread is another brilliant option strategy if you're trading with a small account. Let me walk you through it. Let's go ahead to continue right now. We're going to hit review order, and there you have it. The first strategy, the cash secured put, you was receiving around $27, but in that case, you needed a collateral of $1,350. By making just a slight tweak to this strategy, you're going to now have to leave a collateral of only $50. What that's going to allow you to do is increase the amount of contracts you have. So with this now, the credit you're going to be receiving is going to be lower than the previous option strategy, which is not bad at all. So the credit you're going to be receiving is going to be, let's round it off to $12. Now, the percentage gain is going to be way higher than the previous strategy. And that's because now you're going to have to divide $12 by $50, and that should give you around a 24% return, if my math serves me correct. So, like I said, this is one of the simplest option strategy there is. Now, with a $50 collateral, you're able now to go ahead and enter into 5 contracts. The 5 contracts is going to 5x your estimated credit, and it's also going to 5x your collateral. But once again, with your collateral now 5x, which is going to be $250, it is still going to be better than having your entire $1,350 just sitting there waiting for the contract to expire. Now, this option strategy is a defined risk option strategy, meaning you know what you're receiving and you know what the risk is going to be, what you stand to lose. The other option strategy is a win-win option strategy, meaning you're going to get the premium, and if the trade goes against you, you're going to get the stock. So there you have it. This is an extremely simple option strategy that anyone new to options can perform in order to get consistent income and grow their portfolio at the same time. Now, if you received any value from this video, now would be the perfect time to go ahead, like the video, subscribe to the channel, and once again, if there's anyone out there new to options and trying to grow their portfolio, go ahead and share the video with them. And until the next video, keep growing your portfolio.